Yes, sir. Thank you, Matt. All right, we're going to talk about how to look at the price tag of an option and understand why the option costs what it costs. So you're going to learn about premium, intrinsic value, extrinsic value by the time we are done. A little bit of typing and a little bit of drawing here in just a second. The premium of an option is its price tag, the cost, the price, what you pay for that call or that put. And so if you were to take a magnifying glass and you were to look really close at the premium, you would see it's actually comprised of two parts. And so the first part is intrinsic value. Okay, so premium, P for short, equals IV. IV is going to stand for intrinsic value. And then there's also a second component, which is extrinsic value. So P equals IV plus EV. That's the formula you should memorize if you really want to grasp option pricing. The definition of intrinsic value is it's how much in the money the option is. And so the implication is the deeper in the money the option, the more expensive it's going to be. And when we say in the money, what we mean is the amount of discount it's giving you. If you think about a call option, it's like a coupon. It locks in the right to buy the stock at a certain price. And if the stock price is $100 and you've got the right to buy it at $80, you have a $20 discount. It's $20 in the money. Well, that's going to influence how much you're willing to pay for that, okay? Because you're willing to pay at least $20 because that's how much of a discount you're getting. Versus an option that might be $5 in the money, you're only getting a $5 discount. And so that's going to be reflected in the price. So how much in the money the option is, ITM or in the money. But that's not all that you pay. That's not the only thing that counts. There's some extra stuff, some additional things that you might be willing to pay for. Extrinsic value is how much you pay for time and volatility. So if the option expires in 30 minutes, you're probably not willing to pay as much for it than if it expired in 30 days or 30 months, right? So the more time in the option, generally, the more expensive it is. And I shouldn't even say generally. Always, the more time in the option, the more expensive it is. And then volatility is the expectation of movement. There has to be the assumption that the stock's going to move in that time. Okay, if the company's getting bought out and we know their stock price isn't going to fluctuate for 6 months, then it doesn't even matter if you have a 6-month option versus a 6-day option. There's no expectation of movement. And so there's not going to be much extrinsic value. So generally, the more the stock's expected to move, the more you'd be willing to pay for that option because there's a greater chance of having a profit, right? And so if you think about this P equals IV plus EV, this is where I like to draw a little picture here. And let's assume, again, that we're talking about call options because these are the most intuitive. Say that I've got I got a stock trading for $100. And I'm going to look at this, what is it, April, let's say May, let's go to June. I've got a June 95 call option, okay? And the price of that option, we're going to say is, well, let's think through this. How much in the money is that call option? The stock's at 100. You have the right to buy the stock at 95. That's what a call option does. So I got a $5 discount. So we would actually say that there's $5 of intrinsic value. So whatever the premium is, whatever that ends up being, is going to be, $5 of it is going to be intrinsic value. So I actually know that this call option is going to cost at least $5. Now, why would it cost more than $5? Well, June, when you think about time, June is about 60 days away. I think it's like 65, actually, the June monthly. You got 65 days of time. Well, don't you think the stock's going to fluctuate in the next 65 days? I mean, it gives it a 2-month runway. Could go up a lot in the next 2 months. The fact that you get 65 days of time, 65 days of exposure to the stock, there's value there. There's value there. And so you're going to pay more than $5 for this call because it's giving us 65 days of time. So if we think about let's go blue here. So you got $5 of intrinsic value plus you are going to have a little bit of extrinsic value. Well, how much are you going to pay for the 65 days of time? It probably depends on how much you think the stock could move over the next 65 days. Are we talking about Walmart or Pepsi or some stock where the expected range is really narrow? Or are we talking about Tesla or Shopify or some volatile stock where the expected range over the next 65 days is quite wide? If it's a pretty volatile stock, you may think, this $100 stock could get to 120 in the next 2 months. That 95 call could become quite expensive, right? So I'm willing to, for time and volatility, I'm willing to pay another $5 actually. So $5 of the premium is intrinsic, $5 is extrinsic. So the premium is going to be $10. Okay, so the price tag on that call option is going to be 10. So if I were to put that in a little bar here, I'd say, okay, so the premium is $10. But if I break that down, and this isn't always the case, but in this case, it's half and half, right? So I've got intrinsic value as half of it, $5 of intrinsic value. And then the other half, which we'll actually do red here, is $5 of extrinsic value. Now, why does it matter knowing how much is intrinsic and how much is extrinsic? One of the reasons it matters is because at expiration, one of these disappears. There is no extrinsic value at expiration because there's no time left. And even if you think the stock's going to move in the future, even if you have a volatility expectation, the option's gone. It doesn't exist anymore. It expires right now. And so there's no time. And the vol expectations are relevant because that's a function of how much time you have. And so time and vol don't matter anymore. So extrinsic value is gone at expiration. And the only thing you're left with is intrinsic value. Okay. And so if you're an option buyer, if I buy this call option, right, I'm paying $10. What am I hoping? Well, I know that incrementally this $5 of extrinsic value is going to go away. What I'm hoping is that the intrinsic value will increase. Okay, I'm hoping the stock will go up and the 95 call will be deeper in the money, so it has more intrinsic value. So if I'm lucky, at expiration, I'll have this call option and the stock will be up at 110 and the call will be $15 in the money. And it'll be worth 15 because it has $15 of intrinsic value. Option buyers are hoping the call goes deep in the money because the stock goes up a bunch. Doesn't matter that it lost value due to time decay because that was more than overcome or more than offset by the intrinsic value increasing. That's the hope of an option buyer. I want to buy something now that's cheap, that grows significantly in value. What about the option seller? Final point here. As an option seller, what are you hoping? You sold this thing. You received $10, right? Well, first of all, you're hoping that the extrinsic value goes away. And indeed, you don't even have to hope. It will. But you're hoping it's not replaced by intrinsic value. So this concept of time decay, it's like Pac-Man, okay? You got Pac-Man here. We call him time decay, TD for short. He comes and he eats the extrinsic value like bit by bit. And when we talk about cash flow trading, really what we're doing is we're trying to capitalize on this dynamic whereby these options, they incrementally lose their extrinsic value. That's money that's going to be lost. And if you're an option seller, that's your potential profit. When you sell calls or puts, trying to rely on time decay, you're just banking on the extrinsic value going away. And most of the time, option sellers are selling out of the money options, where whatever the premium is, let's say it's, $2. If it's an out of the money option, the entire $2 is extrinsic value. And as long as it remains out of the money, Pac-Man's going to come and he's going to eat the whole thing. It's going to lose the whole $2 of value by due to time decay, and you're going to capture that whole thing. And so the reliability, the consistency, the predictability of extrinsic value going away is the dynamic that covered call traders rely on, naked put traders, condors, any cash flow strategy. We are gaming this particular phenomenon. And so you understanding this background of what's actually going on, it makes you a more educated trader, makes you understand why these strategies make money. And ultimately, hopefully, it makes you more money. So this concept you can learn more about in the Options 101 video series that we have on Tackle Trading. But now you know, P equals IV plus EV.